So this is what he said here on page 98. And for me, it's the most important passage of the book. Yes, it's a great book. I've read it a couple of times and I recommend it. But he said the state alone is responsible for inflation. Inflation without government or indeed against government is impossible. Wednesday, June 9th, 2021, Maneko 64, home of alternative economics and contrarian views. Today we're going to look at inflation and whether inflation is impossible without central banks. There's a lot of talk about inflation, of course, lately. It's coming up even in the mainstream media. Up until last year, all the talk was deflation. We have, on this channel, of course, been warning about inflation for many years, mainly because we look at inflation very differently from 99.9% of the people. Even some people on the alternative, or most people on the alternative, get the definition wrong. They think that CPI is inflation. So we're going to go over that, whether if we get rid of the central banks, and believe me, I think we should get rid of the central banks, whether we will get rid of inflation. And it's not as simple as people would think. Before I go further, I like to say that if you've just found this channel and you enjoy my videos so far, but haven't subscribed, think about subscribing. Think about telling your friends, family, and colleagues about my channel if you think they're going to like the message. And also, if you do subscribe, don't forget to hit the little notification bell to be notified of all my new videos. So, yes, inflation, it's a raging debate right now. Overnight, for example, we've had CPI data from China. Of course, nowadays we're told that CPI is inflation, but what we have to understand is that CPI is a measure of consumer prices, and inflation is the increase in the supply of money and credit out of thin air that results in higher prices. And we're going to come back to the definitions in a minute. First, let's look at the Chinese number. And I wouldn't trust the Chinese statistics, just like I don't really trust any other country's statistics, US and UK included. So the CPI in China came out overnight. It was expected to come out minus 0.1 month on month, which is a bit of a joke, I would say, and 1.6 year on year. And lo and behold, it was minus 0.2 month on month and 1.3 year on year. Doesn't make any sense, in my opinion. PPI, though, which is the producer price index, came out at 9% year on year. It was expected 8.5%. So that's probably a bit more reflective of how prices are rising. So, of course, tomorrow we've got US inflation, or as I like to say, price data. It's price data, because if you really want to look at inflation, you have to look at the money supply and all the credit being created. Of course, the Federal Reserve has now made it really difficult for us to look at M1 and M2 in the last few months. They've discontinued the number. They're not publishing it every week as they used to. So that's the real inflation, but they don't want you to know about it. Tomorrow, by the way, CPI in the US is expected 0.4 month on month and 4.7 year on year. And that's versus 0.8, 4.2 the previous month. That number was higher than expected. So this is going to be a huge number. It's been decades since the CPI has been important to the markets. It's always been the non-farm payroll. And I know that because I was in the markets for about 25 years in the city of London and at a small bank in Geneva, Switzerland. And CPI now is going to be the most important number because it's increasing. And the way they used to calculate CPI back in the 80s, we're more like at 12%, but that's another subject. So they have a core number as well, where they exclude everything that we really need to survive, like food and energy. That's expected 0.4, 3.4. So before we go into the definition, I like to read here from a book entitled The Raven of Zurich, and I've recommended this many times. The hard copy is really hard to get, very expensive. It's the Memoirs of Felix Somary. You can Google Felix Somary. I'll just say that he was a very influential banker during the World War I, World War II, and post-World War II period, just after the World War II. He was originally from Austria, went to live in Switzerland, and eventually emigrated to the United States. Very well respected, consulted by governments and treasuries, including the US. So this is what he said here on page 98. And for me, it's the most important passage of the book. Yes, it's a great book. I've read it a couple of times and I recommend it. But he said the state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible. So that's what you need to know. Central banks are, of course, an instrument of government, because central banks basically are given a legal monopoly by the government. Without government, there wouldn't be central banks. Look at the Bank of England. It was created by a royal charter, and it was eventually also given the monopoly to issue notes, banknotes, because before that you had free banking. Any bank could issue banknotes. Federal Reserve as well, created by an act of Congress, with, of course, the influence from the bankers. Recommend, of course, The Creature from Jekyll Island. It talks all about how the bankers were involved in creating crises before that in order to convince Congress to create a central bank. The excuse was that it was going to make the currency elastic. It was going to end bank runs and crises. But the crises have become even worse after the central bank. And now to the definition of inflation as per some old dictionaries, because nowadays when we talk about inflation, or not us personally, but in general, they look at CPI. For example, tomorrow's number is going to be looked at as the inflation number. We've seen recently that people are saying that used car prices are causing inflation. We hear and we've heard many times in the past, especially in the 70s, that unions caused inflation because people wanted higher wages. No, the inflation is caused by government and central banks working together to issue money and credit out of thin air without anything valuable backing it at a fixed rate, of course. And what that does, it dilutes the currency, the fiat currency, because it's like a rights issue for a stock. If there are 10 million IBM shares and then they come out and issue another 10 million, that's gonna have the value of the existing 10 million, and that's what government has been doing for generations. That's what inflation is. It's a dilution of the national currency, and it's very simple. But why is the mainstream media, why are mainstream economists, politicians fooling us about this? Well, because they benefit from the inflation. They get the easy money very easily and first, especially Wall Street, the City of London, the big corporations. And we get caught holding the bag. And that's why there's so much wealth inequality. So, to the definition, Oxford Dictionary, Oxford English Dictionary, 1925, to inflate, abnormally increase state currency, especially by issue of inconvertible paper. So what's inconvertible paper? Well, we need to go quickly back to the history of money. Money basically is the most marketable commodity, and over thousands of years, the market has determined that it's either gold or silver. Silver is money more for daily transactions, and gold is money more for storing wealth. And what governments did, not really governments, but the market, a lot of times to facilitate the flow of that money, banks, free banks really, issued notes saying, I promise to pay the bearer on demand the sum of, or, you know, a $20 gold coin or something like that. And that was supposed to be, that promise was supposed to be met. If you went to the bank and you tendered that note, they should have the coin or the specie. But what's happened over the years, bankers started cheating, issuing promises that were not backed by real money. And then, of course, governments have taken over that as well, unfortunately. And nowadays, most people don't even realize that gold and silver are money. They think that these pieces of paper or digital entries are money. So, again, abnormally increase. So you dilute the pre-existing currency. So the solution really is to have government out of the monetary system. Another one, Webster's early 70s, inflation. An abnormal increase in the volume of money and credit, resulting in a substantial and continuing rise in the general price level. Very good definition there. It's slightly different from the Oxford, but nowadays they say that inflation is the rise in prices or the CPI. No, that's the consequence of it. And there's another comment by Felix Somary, the man I spoke about, the Raven of Zurich. And he said in that book, inflation, on the other hand, can go on for years without its victims becoming conscious of the incredible way in which they have been swindled. Yeah, that's because people are tricked. They are tricked by the governments, the bankers, and the politicians, and the mainstream media that's been captured by the same people to believe that inflation is actually caused by greedy businessmen. It's caused by the weather. It's caused by higher holiday prices. They put it all backwards. It's like saying that the wet pavement or the wet sidewalk caused the rain. It's the rain that made the pavement wet or the sidewalk wet. And it's amazing that people still buy into it. What else? Well, there's also the comment by Lenin about inflation. And it says here, Lenin is said to have declared that the best way to destroy the capitalist system was to debauch the currency. By a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. So yeah, this inflation that we've had has been happening since 1971, August 15th. It did happen before, but they've been able to hide it, especially since the early 80s. The inflation has flown a lot into paper assets, stock market, bond markets. They've been able to control it when it starts flowing into consumer goods and services. But now they can't control it anymore. So is inflation possible without central banks? Yes. And usually the way is that governments create huge crises, usually big wars, to excuse them to inflate, because inflation really is theft, if you think about it. So instead of paying them with real money, let's say silver or a gold coin, government, because of the emergency, they say this is an existential crisis. We have to fight the Huns. We have to fight, to defend the Union during the Civil War. They will pass laws to basically cheat the people, to pay them with a empty promissory note. And that's what the greenbacks were during the Civil War. That's why you had massive inflation, even though you didn't have a central bank at the time. That's what the Continentals were during the Revolutionary War. They're just cheating the public to pay for these wars. If the Federal Reserve were to be abolished, we'd still have to be very careful in terms of inflation, because government can still create inflation. All the Federal Reserve has done, in my opinion, is made inflation easier to perpetuate over the years. It's made inflation possible during peacetime, like they're doing right now. We haven't had really a major war since 1945. And you can have governments actually, for example, who do not inflate, like back in the 19th century, from 1814 to 1914, the national debt in the UK actually went down, and the CPI, as measured by the Bank of England inflation calculator, went up like negative 0.1 every year from 1814 to 1914. So it's not a clear-cut subject, but one thing's for certain: inflation cannot be created without government, because basically, as I said, inflation is legalized plunder. It's governments passing pieces of paper for real money, so to speak. So as I said, there's a lot of talk about inflation these days, and there's a lot of misinformation, especially from the mainstream. Martin Wolf, who's a uber globalist, he's a World Economic Forum creature. He writes for the FT. He wrote yesterday, the Fed risks reacting too slowly if inflation keeps rising. Well, it's all backwards, because it's the Federal Reserve that creates inflation, and inflation has been rising for 50 years. What's rising right now are prices, Martin Wolf. One thing I would say as well, there's an economist here in the UK, Roger Boodle. I remember buying the book. I don't have it anymore for some reason. He wrote in 98, The Death of Inflation. And I knew that was hogwash, because he was trying to convince people that a lower CPI or RPI was the death of inflation. And I've known all along that inflation hasn't been dead. But recently, actually, he's saying now that inflation is back. But what he means, of course, is the CPI. Inflation's never gone away, but he's a mainstream economist. He's been given prizes by the major globalist, institutions, Roger Boodle. So, please remember the CPI. That's going to come out tomorrow. That's not the inflation numbers. Those are the price numbers. And if you've been following me, and if you know the definition of inflation, you won't be surprised that prices are rising. So there you go. With that, let's look at the markets this morning. It's 7:30 a.m. London. We've got spot gold at 1892.50. It's basically unchanged from last night. The high's been 1898 and the low 1889. Silver also unchanged, around 2760. The range has been 2776 to 2750. The Dow futures down 11 points, The NASDAQ 100 future is up 6. S&P 500 future is unchanged. The currencies, the pound is unchanged, so fairly quiet the market so far. It's at 141.55. The euro is up slightly at 121.81. Dollar is down slightly versus the yen at 109.50. And the dollar is down 0.1% versus the yuan at 639.32. Aussie dollar 77.40, unchanged. I think we were 77.50 yesterday morning, so it's come off slightly. To the commodities, WTI crude breaking through 70. So 70.20, up 0.33%. I think this is a high for the year. WTI crude. High-grade copper down just under 1% at 4.52. And surprisingly, the 10-year yield continues to languish, which is crazy, seeing that we could even get a CPI of about 5%. The 10-year yield is unchanged at 153. So let's say it comes out at 5% tomorrow's CPI. That means the real rate that investors get for holding a 10-year note is minus 3.5%, because you get the 1.5, and then you take away the rise in prices of 5%, and you get a negative return. So your money is losing purchasing power. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel, as I said earlier. And you can also follow me on all these other platforms below here. I wish you all a great day. Take care. Bye.